Hi, welcome to Smart Investor. My name is Ganesh. Today, we are going to learn an interesting episode on how to pick a right stock at a right valuation. What are the parameters or we need to consider to choose a stock at lower valuation? There are several methods or several parameters we generally use for picking a stock. So generally, when you buy stock at a higher valuation, whenever there is a correction, that stock will be corrected drastically, which is actually happened year 2022. Many people were locked due to they entered the stock at a higher valuation, and now those stocks are into deeper correction at any point of time. So we need to scan certain parameters to choose a right stock. How do you know whether the stock is right valuation? How do you know this specific stock is that I am buying is at a good value? So there are the very good parameters available. We need to check it out. Out of this, there is a one beautiful parameter people rarely use is called PEG, PEG. I will show you all this thing and explain one by one what is this and how to choose the stock based on the uh, PEG parameter. Let's see screen sharing and walk you through all those details. PEG, which is price to earnings to growth ratio. This formula of PEG ratio formula is PE ratio divided by earnings growth rate. So what is PE ratio? What is earnings growth rate? These two parameters are involved to calculate a PEG ratio. Do we understand what is a PEG ratio and altogether? Generally, what we do, a stock is lower valued or overvalued or expensive stock. How do you know? Generally, people traditionally would look into P ratio. Any stock is considered below 20 is considered a good value stock, or above 20 or 30 is considered expensive stock. Of course, these P ratios are different sector to sector. For banking sector, P ratio would be 20 plus or minus 1. Or IT stocks, yeah, that P ratio would be around again 20 plus or minus 2. Whereas for FMCG sector, P ratio always will be higher, like 50, 60 or 70, it would be like this. However, if I buy a stock at a P ratio below 20, does it perform very well in the future? Does it continue to grow very well in the future? How do you know that PE? PE doesn't show that what is the current PE would be having greater value in the stock upcoming years. So this is why we need to understand whether this particular stock is growing at what rate. So we need to understand the stock growth rate along with the PE ratio. That gives you a PEG ratio, which gives you whether the stock we choose is right value or not. PE ratio. PE ratio is price by earnings. Earnings in the sense, so profit the company has got per year or per annum. What is the price? Price is the closing price of the day or current live price of the stock. How do you calculate EPS or earning per share? Net profit, which means like a trailing 12-month profit divided by current shares outstanding, or net profit divided by average shares outstanding for the financial year. Let us say a company has earned a profit of 1 lakh per annum. The company has a total number of shares, let's say 1000, which means 1 lakh net profit divided by 1000 shares, which gives 100 rupees. This 100 rupees is called earning per share, means total 1000 shares. Per each share the company earns 100 rupees per annum. This is called earning per share. A investor, how many times more would like to pay the price of that earning? So to calculate a PEG ratio, we need to know PE ratio and we need to know earning per share. When we have a PE ratio, we have a EPS, then we'll calculate growth rate. How do you calculate a growth rate? Let us say financial year 2022 EPS is 2.5 or 3 or 3.5. If EPS is growing per annum like this, we will calculate growth rate at what percentage it is growing per annum. So normally a company's growth rate would be 10% or 20% or 30% would be calculated like that. So a good PEG ratio, generally we look into that PE ratio and growth rate should be equal, which means PE ratio is 20, growth rate is also 20. That is considered very ideal value stock to buy, or the stock is trading at a very good price, which means the PEG ratio based on the formula, PEG ratio is PE. If you see the PEG ratio formula, right? PE ratio divided by earning growth rate. PE ratio is, let's say, 20. Earning growth rate is 20. PEG ratio would be 1. 20 by 20, 1. That's how we calculate. What is a good PEG ratio? A good PEG ratio or PEG ratio as a value lower than 1 is considered a good PEG ratio. PEG ratios greater than 1 are generally considered unfavorable, suggesting a stock is overvalued. PEG ratios lower than 1 are considered better, indicating a stock is relatively undervalued. Hope the PEG ratio is clear now. Let us look into some samples. Let's take IT companies. Let's say majorly we take 6 companies: TCS, Infosys, HCL Tech, Wipro, LTI Mindtree, and Tech Mahindra. If you see these values, so which stock is undervalued or which stock is good to buy based on these ratios? Generally, traditionally, people look into that PE ratio. What is the lower PE of this list of the companies? Wipro. Wipro has a PE ratio of 19. Does it mean that, yeah, Wipro is a good buy at this value? No. So as we discussed before, we also need to add PEG ratio to that, which means what is the lower PEG ratio out of all these IT companies? Lower PE is Wipro, but lower PEG ratio of the company is Tech Mahindra. That is 1.38. So if you add PEG ratio to the company that we choose along with the PE, we will get much better value, because PEG would be telling us that this company at what rate is likely to grow better, and which company is lower value and would perform, will going to outperform in upcoming years. That is why PEG ratio is a very critical indicator for us to choose a better stock. Does it mean tomorrow all of us go and buy Tech Mahindra since PEG ratio is 1.38? Of course, this PEG ratio is more than 1. But out of all these 6 companies, lower PEG ratio is there with only Tech Mahindra. So these are PEG ratio is alone is not the one indicator to decide this is a stock to buy, but this is one of the most important parameter or indicator we need to check. Normally, yeah, this is one EPS into multiples of PE gives you price of the stock. For example, the TCS will find it like this. EPS for the trailing 12 months is 111 into PE ratio is 30.1, which gives 3,341.1 approximately what is the current price. Now, here I'm going to show you two companies peg ratio is what we discussed. Means peg ratio, what is good peg ratio? Which is less than 1. That is one first company I'm going to explain, the Tatasteel. What is the Tatasteel PE ratio? 7.4, which is good. And EPS 13.8 rupees. What is the peg ratio? 0.1. Very low, means lower than 1, and also very, very bottom of the peg ratio that we generally will look into that. Which means based on the discussion ratios, Tata Steel is a good company to is expected to perform very well in upcoming time. And another stock is ONGC, Oil and Natural Gas Corporation Limited. Stock PE is 4.96. Earning per share 13.3.6 rupees. And peg ratio is 0.35. Again, this is also below 1. So based on these values, for long-term investor need to consider how to choose a stock, whether it is undervalued or overvalued. Based on that, and this stock how going to perform upcoming years, we need to find out like this. So traditional PE ratio, if we add peg ratio, it gives you more data and more confidence to buy that stock with more conviction. Thank you for watching. Hope this video is useful to you. Please subscribe and like and comment and share if you like the video. We have a Telegram channel where we discuss several such things and during live market as well. Please join us to have more discussion and a friendly discussion on various topics, futures and options, and stocks, fundamentals, and many other details. Thank you for watching once again. Bye.